A further advantage of Forex trading is found in its versatility of trading strategies and instruments. Markets such as stocks or commodities may impose lot sizes, opening restrictions, or single direction limitations. In FX, as noted by Baby Pips, there is no fixed lot size, and you can trade smaller units, micro lots, mini lots, nano lots, to match your risk tolerance. This flexibility allows newcomers to ease into live trading at lower dollar risks and build confidence gradually. Moreover, FX allows for a wide range of time horizons and styles. Scalping, day trading, swing trading, carry trades, position trades, algorithmic strategies. They all find a home in FX. Some brokers offer derivatives, options, CFDs on currency pairs, increasing the toolbox available to the trader. As highlighted by Statries, FX's large size, combined with hedging flavor, mean you can adapt your style as you learn and grow. Another point that draws beginners is the relatively low barrier to entry compared with traditional institutional channels. From trading apps to low minimum deposits, modern FX platforms enable retail participation in what used to be a large institution-only club. The accessibility factor is crucial. It democratizes the market and allows eager individuals to engage, experiment, and learn. Yet, it's important to emphasize that this accessibility is not a guarantee of success. The democratization of FX means more participants, but not all will succeed. This underscores why trading must be approached with humility, education, systemization, and discipline. The environment may be friendly to beginners, but it rewards those who treat it with respect. One of the less often appreciated benefits of FX is its hedging and diversification utility. While many view FX purely as speculative, corporations and institutions rely on currency markets to hedge global cash flows, trade imports/exports, and protect balance sheets. According to Investopedia, firms engage in FX to hedge currency risk and manage exposure to exchange rate changes. For a trader, this underscores the maturity of the market. It's not simply speculative, but a foundational part of global finance. When you participate, you trade in the same system trusted by banks and multinationals. From an individual's perspective, this hedging function means FX is often less manipulated than some financial markets, because the daily volume is so vast, running into trillions. The chance of a single actor cornering the market is significantly lower. Baby Pips notes that significant manipulation by any single entity is all but impossible during active trading hours for the major currencies. For beginners, this offers a level of confidence that the market is structurally sound and not easily compromised, though liquidity conditions and events still matter greatly. Additionally, the global nature and variety of currency pairs mean you can adapt your trading to your experience, timing, and interest. You might focus on major pairs for reliable liquidity, then gradually explore minor or exotic pairs for additional opportunities. Each with distinct dynamics, the ability to tailor your trading universe is a meaningful benefit for someone building their path. However, trading FX is not without cost. Despite many benefits, spreads, commissions, slippage, and overnight swap rates apply. As always, understanding and respecting the cost base is part of prudent trading. Because of why trade FX? Argument is strong, but only when paired with how you trade matters just as much. In summary, the question why trade Forex finds multiple compelling answers: continuous accessibility, high liquidity, flexible sizing, two-way trading long/short, leverage opportunities, and global scope. Robust platforms, mobile access, and education resources now make entering the FX market more straightforward than ever, especially for beginners. These advantages are often cited by brokers and educators alike. For example, the list of benefits from IG includes volatility potential, around-the-clock trading, high liquidity, leverage, and a wide range of currency pairs. Yet truly capturing the benefit requires more than awareness. It demands process, discipline, capital management, emotional control, and continuous learning. The same features that make FX rewarding, access, liquidity, leverage, can also expose traders to risks if unprepared. As noted by Investopedia in its pros and cons of Forex trading analysis, low overhead and high liquidity are advantages. But the leverage, accessibility, and volatility mean that inexperienced traders risk serious losses if they ignore risk controls. Therefore, as you embark on your trading journey, with the foundations laid by this book, remember, the why of FX trading is powerful, but the how will determine your results. In the chapters ahead, we will build that how, developing your process, chart reading, technical/fundamental integration, risk rules, and psychological discipline. Section 1.4 Key Players in the Forex Market. Page 1. The global foreign exchange (FX) market is built on the actions and interactions of a diverse cast of participants, each with distinct motives, tools, and influence. Among them, the most powerful are the central banks, institutions that issue currency, set monetary policy, and sometimes intervene directly in the market. According to Bank for International Settlements (BIS) research, central bank operations and announcements regularly send ripples across FX markets because they alter expectations about interest rates, money supply growth, and currency valuations. For example, when a central bank raises its policy interest rate, its currency typically strengthens as higher yields attract foreign capital. Conversely, expanding the money supply or signaling future easing can lead to depreciation. Because the scale and credibility of central banks far exceed most market participants, even a hint of intervention or verbal guidance can cause large fluctuations in major currency pairs, even without direct market operations. Central banks do not trade purely for profit. Instead, they are guardians of macro stability, managing inflation, aiming to support exports or stabilize exchange rates. Yet because their footprint is so large, recognizing when central bank policy is shifting becomes a key edge for a Forex trader. As you advance to the chapters ahead, understanding how central bank objectives drive currency flows will help you interpret otherwise random price moves and align your trades with structural forces. Page 2. Moving down a tier, commercial and investment banks dominate day-to-day volume in the FX spot market. These institutions act as both liquidity providers and dealers. They execute client orders for corporations, hedge funds, or retail brokers, and trade for their own proprietary books. According to a deep dive into FX market participation, major banks such as J.P. Morgan Chase, Deutsche Bank, Goldman Sachs, and Citigroup frequently rank among the top-tier liquidity providers. These banks shape market structure in a number of ways. They set the bid-ask spread indirectly through their quoted prices and internal risk assessment. Their aggregated flows, whether from corporate hedging or speculative books, help define what other participants see as market consensus. Their interbank relationships underpin the inter-dealer market, which remains a backbone of global FX liquidity. For the retail trader, understanding that the flow monsters banks are often one step ahead means you must adopt humility. You may not trade the same size, but you can trade in alignment with how they move. That means watching for levels that banks defend, ranges that shrink during low volume, and days when anticipated policy shifts cause heavy bank-driven initiative. When banks lean one way, chances or flows will follow, and as a smaller player, your job is to spot when the balance shifts. Page 3. Another critical group is multinational corporations and import-export firms. These participants engage in FX as part of their operational or hedging needs rather than purely for speculation. For example, a U.S. company importing components from Europe may need euros to pay suppliers, thus resulting in conversion from USD to euro. While their individual trades may not dominate daily spot volume, cumulatively corporates are significant. Their flows are often more predictable, driven by trade invoices, capital spending, or foreign acquisitions, and thus sometimes provide structural support for currency trends over weeks or months. In other words, corporate FX hedging adds ballast to market direction when combined with macro fundamentals. For the beginner trader, the takeaway isn't to trade like a corporate treasurer, but to recognize when major business flows are at work. For example, when a country's exports surge, its currency may appreciate. When a multinational repatriates profits, its home currency may strengthen. These phenomena often coincide with major event windows, trade reports, earnings seasons. Incorporating awareness of business flow drivers alongside technical levels gives you a richer perspective. In this ecosystem of institutions, each class of participant has different objectives. A key reason why currency behavior sometimes defies simplistic logic. Page 4. Next, we turn to investment managers, hedge funds, and sovereign wealth funds, often collectively termed speculators, although that label undersells their sophistication. These entities deploy large pools of capital to seek currency return, hedge portfolios, or engage in carry trades, borrowing low-yielding currency to invest in higher-yielding one. According to the Who Trades Currencies and Why breakdown by Investopedia, hedge funds and portfolio managers form a major chunk of FX activity beyond banks and corporates. These players usually run systematic strategies, quantitative models, or discretionary macro trades. Their large size means that when they commit substantial capital, for example, a heavy short in JPY, the market often moves to accommodate. For you as a trader, tracking when large funds shift or unwind is a higher level skill. But you can begin by following center of gravity levels or areas where long terms were previously defended. One more category, the retail traders. While their aggregated volume remains much smaller than banks or funds, their numbers have exploded thanks to the internet and low-cost brokers. Many educational platforms estimate retail traders now account for up to 10% of spot turnover in certain sessions. Retail traders bring liquidity, emotion, and sometimes predictable behaviors, e.g., stop-run hunting near obvious levels. Recognizing where retail order positioning may cluster helps refine your risk management and entry strategies. Page 5. Finally, we must mention the other service providers and technology-enabled participants, brokers, electronic liquidity providers, Yelpies, algorithmic firms, and even payment services companies. The Forex market shift to electronic matching, aggregated liquidity pools, and execution algorithms means these participants shape how you trade, even if you never meet them. Liquidity providers, banks, and non-bank flow firms determine how tight your spread will be. Brokers decide whether you trade on A book, passing trades to the real market, or B book, internalizing trades. Their choice affects execution, slippage, and risk. For retail traders, selecting a regulated broker, understanding execution model, and checking liquidity depth are vital. In summary, the FX market is not a monolith. It is an ecosystem of central banks, major banks, corporations, funds, retail traders, and infrastructure providers. Each layer adds depth, and each influences price differently. When you trade, you place yourself within this structure. You aren't fighting it. By understanding who moves a market, you gain a broader frame. Rather than reacting aimlessly, you can anticipate where liquidity and order flow may converge. With that awareness in place, The next chapters will show you how to interpret chart structure, read price action, and align your trades with the flows created by these key participants. And that brings us to the end of Chapter 1, Understanding the Forex Market. I truly hope this chapter has helped you gain a clearer picture of what Forex trading really is, how it started, who the major players are, and most importantly, why this market remains such a powerful opportunity for disciplined traders. Remember, mastering Forex isn't about rushing. It's about building knowledge one concept at a time. So take a moment to review your notes, replay any section that stood out to you, and let the lesson sink in. In our next session, we'll move on to Chapter 2, Currency Pairs and Market Mechanics. Here, we'll explore how currencies are paired, how exchange rates move, and what truly drive the heartbeat of every Forex trade you'll ever take. If you haven't already, please subscribe to the TheRockFXHub, like this video, and share it with anyone who's also learning how to trade. Your support not only helps the channel grow, but also ensures you'll get notified the moment Chapter 2 drops. Once again, thank you for listening. I'm Peter the Rock, and I'll see you in the next chapter. Until then, trade wisely, stay disciplined, and keep learning.